Thank you, everyone, for those who are attending the TOS Securities Investor 25. And I'd like to say special thanks to the Ken Fisher, the one of the world's most renowned investment guru and the figure deeply respected by the investor globally, including and especially here in South Korea. Thank you for joining us to Securities Invest 25, Ken. Can you kindly introduce yourself to a little bit to our audience today?
Well, thank you very much for the introduction, and thanks for having me here today. It's a pleasure and an honor. Before doing that, let me just say that congratulations to TOS Securities for putting this conference on as an inaugural conference. And congratulations to all of you that are attending, because educating yourself more about how investments work, how markets work, and how you fit into that and how you don't fit into that, whatever and all of that will be for you, is in fact the best way to do better with your investments. And so I congratulate you for participating in this. Me, I'm an old salty dog. I'm 74 years old. I've been in the investment business for a little over a half century. Started in 1972, just before the big bear market of 1972, 3, 4. And founded a firm some few years later that today is a fairly large firm, managing a little over 300 billion US in global securities, operating around the world with some 6,000 plus employees. I've spent a lot of my life trying to do what you're doing today, which is learning more about how markets work in ways that people don't fully necessarily understand, and more about where I fit into all that. And at my age, I'm still doing that. It's a never-ending process. And let me just make one more point. When I was young, a long time ago, Warren Buffett said that this is a realm of endeavor where if you end up being right 70% of the time, in the long run, you become a living legend. So you better be used to the fact that you're still wrong a lot, fully 30% of the time. And the goal is to be more right than wrong. And the way you become more right than wrong is exactly what you're doing today. The fact of the matter is, when I was young, I also was enamored with boxing. I'm not really a sports person and haven't been since I was a boy. But when I was enamored with boxing, I did a little of it. I was okay. I wasn't great. But in the process of that, I learned that you got to be able to be hit and keep going. And in markets, nothing works all the time. There is nobody that knows everything and is always right. Your goal is to be right more than wrong. And the key to being right more than wrong, in an overarching sense that people have a hard time getting in their bones, is to somehow, some way, know things that other people don't seem to know. Either facts, how markets work. People think this causes that, but they don't, and you know why. And all of that comes from studying and learning. So again, I encourage you to not just today, but for the rest of your lives, engage in this process of learning about how markets work better and more, and realizing that you will make mistakes, and that making mistakes is okay, because the goal is not to be perfect. The goal is to be right more than wrong. And if you are right more than wrong, you'll be very successful.
Thank you very much, Ken, for you're already sharing a lot of wisdom for the investor for TOS Securities. You mentioned about the market is continuously evolving. At the same time, there are a lot of things to learn for the investor. So it's important to continuously participating and learn from the market. But at this moment, there are a lot of uncertainty has been boiling around right now. So especially for the global tariff situation. So we want to know about how will the Trump's tariff impact the U.S. stock for the remainder of 2025, and which U.S. sector or ETF could be the worst to looking at for the TOS securities investors to navigate uncertainty. And just want to share, it would be great if you can share the broader outlook for the U.S. stock market moving forward.
So first, and I'm delighted to do that, and it's a very good question. But first, let me say that the right way to think about all this stuff always, and this is true whether you're an American or South Korean, and oh, by the way, I love South Korea. I've got have South Korean grandchildren, 4 of them, and I love all things about South Korea. But wherever you're from, it doesn't really matter. The most important thing to do always is not to think about how will the American market do, or how will the South Korean market do, but to first think about how will the world do, and think global first and your own country second, because the way the world goes will impact hugely what happens to your own country and to other countries, and understanding how those pieces fit together is critical to getting it right. So to the question, first, there's always uncertainty. If there's not uncertainty, that's really scary. When people don't think there's uncertainty, it's a bad thing. Uncertainty is fear, and fear in the market is a good thing. And fear of a false factor is always bullish. And excess fear of something that's bad, but not as bad as people expect it to be, is also bullish. It's when people are overly optimistic that it's bearish. So having said that, tariffs are bad. They're always bad. There's no exception to that. They're a form of dislocating tax that not only puts burden on a consumer, but dislocates supply chains, makes firms operate in ways they didn't operate previously, which is costly to adjust to. In that, tariffs are always bad, but they're always worse for the country that imposes them than the country they're imposed upon. It's a basic lesson from history that most people don't particularly assume. From that, you get what is evident in the market this year, which is that the United States, which in the last 2 years, 2023 and 2024, was the #1 performing stock market in the world for those 2 years, is now operating, depending on which currency measure in, between number 38 and number 42 out of the 47 countries in the MSCI All World Index. The United States market is lagging badly. Now, there's a couple of points about that that are important to understand also. Yusuf mentioned the sectoral makeup. And when you think of sectors, if a sector is going to do better, countries that are strong in that sector do better. If a sector is going to do badly, countries that are big in that sector tend to lag just because of the weighting of the country market, big or small in the sector. So in the United States, over those last 2 years, depending on exactly when you're measuring, technology was 36 to 44% of the US stock market. And therefore, when tech would do well, as it did in those 2 years, it makes the United States do particularly well as a country market. Countries that were very value-oriented tended to lag in those for the same reason. In this period, for a whole series of reasons, value stocks around the world are doing a little better than tech stocks, which are lagging. And in that, that contributes to the US lag. But when you think about, and we could talk about some of those reasons if you want later on, but if you think about it, a big part of that itself is the tariffs. And as I said, tariffs are always bad. They're worse for the country that imposes them than the country they're imposed upon. Other countries, and in the case of the United States, you can see this, but it applies even more so with other countries. When you impose tariffs, they impact everything that goes on in manufacturing and product consumption of manufactured goods in your country. But the rest of the world, which is 3 times the size of the US economy, can keep trading amongst themselves. So it impacts them less than it impacts the country that has the tariffs. So this is a year for non-US to lead. That should continue. Donald Trump's policies are not good, even if he simply wanted tariffs, because as you read the news, he makes an announcement. A few days later, he changes the announcement. A few days later, he changes something else. Then he changes another thing, changes this, changes that, and that on, off, up, down, left, right, sideways, and off into outer space, some crazy place, is a level of raising uncertainty. And one of the most basic lessons about stocks is stocks hate rising uncertainty and they love falling uncertainty. It's not the absolute level of uncertainty that matters, but whether the uncertainty will rise or fall. And even this last week, Donald Trump said, and I'm sure you've read in the news, that he was going to impose 50% tariffs on the EU countries starting on June 1st. I can't remember if it's June 1st or June 2nd, but the beginning of June. And then yesterday or the day before or the day before that, he announced he was going to move that to July. And what will he do when we get close to July? No one knows, and probably he doesn't either. And that's part of the uncertainty problem.
Thank you very much for sharing. I want to add a little bit more on the question. There's so many books of what you wrote are famous in Korea, but one of the most famous book is the Beat the Crowd. And in the book, you emphasize about outsmarting the herd or the leveraging the investors' behavior. And based on your observation at this moment in the close to the end of the May 2025, which part of which tool of the market metrics should the TOS security investors need to focus to identify the undervalued stock to find investment opportunity to beat the crowd?
So that's a great question, and it's always a great question. It's a great question every year. But let me say that it's never a question for all time, because in the long term, things phase in and out of favor. And what's going to work this year may or may not work next year. And you have to look at that kind of 1 year at a time as you move forward. So what I'm about to say and what I've been saying is never about a long-term forecast. I just want to be clear about that. Secondarily, this year, the features that are the part that's most underappreciated, and therefore, let me go on a tangent for a second. Valuation by itself is never predictive of stock direction. Valuation by itself is something that is so widely known at a point in time that it's already priced into securities. It is not something that, if you said this is a low PE stock or this is a high PE stock, the marketplace knows that broadly. This is a sector with a low PE or a high PE or price to book or price to sales or dividend yield. The market knows that. It's always that by itself, it's what isn't priced in that makes the difference always. So in this year, there's a couple of features that you can see. The economies, particularly the big ones that haven't been doing well over the last few years, where sentiment has been very dour, are actually doing better than people have expected and will continue to do better than people have expected. And that helps the value companies more than the growth companies, because the value companies are dependent on the economy and on financing. The other part that goes with that people don't seem to think through very fully, and I'm just going to sidestep in history for just a few years. In 2022, as the year progressed, the so-called yield curve, or the shift in short-term interest rates to long-term interest rates, where normally short-term interest rates are below long-term interest rates, and there's a continuum from 90-day government bills out to 10-year government notes, is upward sloping, like that. And in that was always, if it was steeply upward sloping, seen as bullish. And sometimes short rates would rise relative to long rates, and that would be called inverting this, which is referred to as the yield curve. That's deemed to be bearish and recessionary, and yet a little bit like people driving a car looking at the instrument panel on the car, by 2022, that had worked well enough, long enough that people just looked at the dashboard on the car and didn't think about what was going on under the hood that the instrument was supposed to reflect on the dashboard. And so when that stopped working in 2022 and the yield curve did invert and everyone said we're going to have a serious recession, but we didn't, people just kind of scratch their head and say, I don't know what's going on here, but that thing's broken. It's not working anymore. It's like that time that the thing told me that my oil pressure was no good in my car, but my oil pressure was just fine in my car. I can't pay attention to that thing anymore. So in reality, the reason that it always worked, what was going on under the hood, is banks are core businesses borrowing short-term funds to finance long-term loans. This is a fundamental truth of banking that's gone on as long as banking's been around. Borrow short-term funds to make long-term loans. So the spread between them is reflective of future profitability of lending, which is reflective of future quantities of lending. And if you're going to grow as an economy, you need ample lending to fund the companies that can't get lending otherwise can't get financing otherwise from the stock market. When short rates get above long rates, that kills lending. This is a core central feature, and you get recession. It didn't work in 2022 because global central banks around the world had flooded the system with cheap money in reaction to COVID, and banks had oceans and oceans and oceans of cheap deposits that they'd accumulated in COVID and the very scary aftermath of COVID that literally scared people nearly to death in 2020 and 2021 into 2022. And from that, banks kept lending because they had a very cheap, low-cost funding base. And people stopped paying attention to the yield curve. Since last year, in parts of the world, and particularly in Europe, central banks have been cutting short-term rates while long-term rates have gone up some, which has taken the yield curve and moved it from looking like this to being back upward sloping. This is particularly strong in Europe. But it's true around the world. And where is it least true? The United States of America, which has contributed particularly to value stocks doing well because value stocks are economy dependent and bank financing dependent. They need loans to finance their growth, to buy inventory, to do capital projects, longer term loans, to do anything that's growth oriented. They can't finance that with equity because they don't have the money to. Growth companies have fat gross margins. They can sell stock when they want, et cetera, et cetera. So in that shift has focused particularly on non-US banks, non-luxury consumer discretionary goods, and industrials. This is to your question. The three parts that people don't get because they're blinded to it behaviorally are those three categories, which have been running strongest this year, and I expect will continue to run strongest this year. As to 2026, we'll have to wait and see that as we get to the end of 2025.
I'm pretty sure the old audience right now is making the markdown of your comments of the three sectors you are bullish on up to 2026. I wish I can have a whole day long session speaking with you, Ken, but due to the time constraint, I need to move on to the final question, which is the advice for the retail investors in Korea. Can you sharing those investors that one or two the key lessons or the your advices so that how you were able to build your wealth over your time over the past decades, and then which could be still helpful for those young investors in Korea, able to help them to build wealth for the next couple of decades.
Number one, and above all, what can I fathom other people don't fathom? Think about what it is that's true that everyone else isn't talking about, because that actually is not in the marketplace now. And what is my brain doing to blindside me now? And this is the part that Jacek mentioned, that's the behavioral finance portion. And then crucially important, what do I believe that's actually false? And in fact, most people believe a lot of things that are false. Most investors think about investing like it's a craft, kind of the way we treat medicine or many crafts, accounting, a lot of categories of commerce, where you learn a craft, you perfect your craft like a dentist would, and then you stick to the craft and do not vary from the craft because that would be bad. In this often would be somebody who believes that value stocks are always better, or growth stocks are always better, or you should always have this one thing. And of course, markets see through that really quickly and keep morphing, because the whole purpose of the market at one level is to keep changing, keep adapting. And your goal is to say, what do I believe that's actually false? Because if you believe that it's actually false, there's probably an awful lot of other people who do too. What can I fathom other people don't fathom? Which is trying to, if you will, beat the crowd, get ahead of the crowd. And three, what is my brain doing to blindside me right now? Because all of our brains have biases built into them from the time we were young, and coming to understand the behavioral aspects of finance, what's otherwise known as behavioral psychology, helps you learn your own blindsidedness and get over your own biases. And as you do that, you end up being a better investor. So thank you for the questions. Thank you for your interest. I've enjoyed being with you, Jisuk, today. And I look forward perhaps to being able to do something like this another time, either by video or in person.
Thank you very much, Ken, for sharing your wisdom today. I believe that your comment and wisdom is definitely making a Toast Investor 25 event very special for this special day. So we're looking forward to see you again. And then I was really, truly grateful to having with you. Thank you very much, Ken.